Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we get to go through the EIA data, what other data points have come out from Europe, Asia as well, and we're going to break it down into our normal segment one being that global overview and then the highlights of the EIA data, a deep dive on U.S. refined product demand, and then segment three going abroad and looking at U.S. exports and what is happening in the physical market as well as the global market, especially as Asian COVID cases continue to rise. So in the segment one, we're just going to kick off with some fun chart that we got in terms of what Biden is trying to do with his emissions goal. And the thing is, when we think about the emissions goal, and the reason why this is relevant is because we continue to see slowdowns on new permits, issues in terms of when our tender is going to go in terms of Gulf of Mexico. So we always want to look at, okay, well, what is the annual emissions goal? And this is just looking at CO2 and what that emissions looks like. So you can see from 2005, we've had a steady decline. It started to flatten out a bit, but now obviously with COVID and other things, things slowed, and that obviously aided the emission side. But the new proposal is to get to by 2030 by cutting it from 2005, cutting it in half. So going from 6 million tons to 3 million tons. And that's going to be one of those bigger moves. So, what is the pledge in general? So the target more than doubles the country's prior commitment under the 2015 Paris Climate Agreement. So we not only re-entered it, we re-upped with what our target is. The announcement comes before the president hosts a closely watched climate summit on Thursday's Earth Day with world leaders from countries like China and India. Obviously, this was last week. So this is just an interesting thing to see, okay, well, how is this going to be targeted? Is it possible? And what is going to be the cost? And that's why when we look at the infrastructure deal that is being proposed of about, almost $2 trillion, a large part of it goes to addressing the emissions. And we can go through many debates on how you do that, what is the cost. But again, these are just some of those things that we're continuing to see that we want to just look at when we're considering how is this going to impact gasoline demand, diesel demand, biodiesel, biofuels, RINs, especially when we look at corn up another 11 today, beans up another 20. And again, some of these things continue to become a bigger and bigger issue. But while all that is being said and we wait for the Fed meeting to happen today, you can see that crude futures continue to move higher. Everything is, when you look at the green, which is 2 weeks ago, versus the yellow, which is right now, you can see that we're pretty close when you look at the curve in general, except obviously the first, let's say, 4 months. Everything is trading above 55 as we get into November of 2023. So again, that opportunity to hedge, at least protect yourself at certain different points, remains available. And it's, again, reasons why we continue to see this acceleration. Now Nove or National Oil Well Varco is talking about increasing some of their production for components going into frac spreads, as we've been talking about. And then we have a report coming out with AOGR. And as we continue to talk about in the Frac Spread show, there is that urgency to figure out, okay, we're at 220 spreads. Where do we go from here? What do we have to order? Do we need new parts? Do we need new rebuilds? Do we need new whole horsepower? Can we buy it cheaper in the market and below replacement cost to upgrade it? These are things that are going to continue to happen, and it's being supported by this chart specifically. So when we look at COVID, these are things that will remain in the lexicon, unfortunately, longer than we'd all like. And we always look at, the worldwide continues to stay elevated, and it's really being driven by Asia Pacific. Latin America is another big driver behind it, but the biggest surge has been coming from India, which we'll get to. So the European Union has started to see a steady decline for the most part, really being driven by France and Italy. Macron Friday is going to come out and talk about what that reopening plan looks like. Italy is going to start reopening next week. All of those things are net positive, and you can see people are starting to feel a little bit better when we look at the driving data in a few minutes. And then, but when we look at Germany, Germany remains sticky. They're unable to really get to where they need to be to see some real reopening, which again is keeping things a bit stagnant, while we continue to see South Korea, Japan, and India moving higher. And India is the biggest issue right now when we look at it, because it's starting to spread into the surrounding areas, both Nepal, Bangladesh, Pakistan, and now Vietnam has just recorded their first Indian variant, which the question is now, okay, well, did it already spread? Did that person pass it around? And these are the different variants that we're facing as vaccines have been slow to reach a lot of these markets specifically. And now when we turn to the crude, we had a small draw of about 90,000 barrels. So it was really not too. Small build of 90,000 barrels. But then when we include the SPR, we had a draw of 1.36 million, and you can see it was driven by Pad 3. So Pad 3 had the draw of 5 million. Everything else recorded a build, specifically Pad 5, after we saw that big increase on the import side, and which we'll talk about in a minute. So Pad 3 is being impacted by a slowdown in imports, even though exports, again, remain depressed, which we continue to talk about. But we did see runs increase. We did see imports stay low, so that helped pull product, or at least oil, out of the market, out of storage, as Cushing increased by 720,000 barrels, and we continue to see some of these builds. But as we said last week and the week before, it's going to be fairly flat. The exports remain weak. Imports continue to be fairly lumpy, which we've been talking about. As we've been saying, Pad 5, we've been waiting for those imports for 2 weeks as delays continued to hit the West Coast. We saw it. It was like, okay, when is this going to actually hit? And obviously it hit all at once. But this is when we start looking forward. And then when we look at production, again, it's a calculated number. The frac spreads are there. We got to this 220 level only 2 weeks ago or so. So again, it takes time to see this start to work through the system. And not to say that it's going to be this explosive growth, but we're going to see that steady move up as a lot of these wells start to turn on. And then when we go abroad, so stockpiles last week rose by 500,000 barrels. And you can see that we remain at the top of the 5-year average. And when we look at east of Suez, you can see that we're now above the 5-year average. And then west of Suez, between the U.S. and ARA, right in line with, between the 5-year average and the top. But net, we continue to see this stickiness, staying above instead of really starting to draw down, as a lot continue to expect. And it goes back and forth. So just to give some high-level color on some of the physical market movements, because that's where some of this is going to go. And east of Suez is going to be the most complicated because, again, we continue to see some of these issues with India and some of the other Southeast Asian nations. So Angola's crude for June loading has already sold 50%, which is a faster pace versus what we've seen, which is a net positive. And it could very well just be China coming back, seeing, starting to pick up a bit more cargoes. We've also seen a fairly decent discount come through, which has also been able to accelerate. But now the widening of the spread between, Dubai Brent is going to make it a bit difficult, and will actually favor some of the Middle Eastern crudes versus West Africa. Nigeria is yet to begin to sell June cargoes because they were sitting on so much May. But May, at this point, they've essentially been able to clear most of it with a few residuals. So Angola sold about 18 of the 37 cargoes it plans to export in June, slightly faster than their normal cycle. But 2 to 4 of the consignments may get to see reoffering, which is down from 10, which is, again, some of that net positive that they've changed hands. Nigeria has yet to sell 5 May cargoes. That's almost 10% of the 54 that were still scheduled to be sold as of April 14th, where they had about 25 to 28 left. June cargoes are still yet to sell. And then in Congo, they're increasing exports, and they still are to the highest level since December, and we still haven't seen any of their products sell. So again, there's some of those mixtures, because the reason why we're focusing on West Africa, a lot of those crudes have been heading into Asia. So now, as we start to see some more competition, some of the Middle Eastern crudes coming through, Nigeria's, a lot of their cargoes had initially been sold to India, and now with India facing their issues, what is that going to do, and is that going to push more into some of the storage or into floating storage, which we'll talk about in a minute. And then when we look at road fuel demand, you can see that there's been that steady decline in both China and rest of Asia. So really the Asian continent continues to see some of these headwinds. When we look at just mobility and activity, Europe has had a nice recovery, as we were talking, as things have gotten better in some parts of the different countries. You've started to see a bit more mobility, a bit more action, while North America is essentially flat, given the issues that we continue to see in Canada. And as we said last week, gasoline demand has really kind of plateaued within the U.S. with this ebb and flow that we expect over the next several weeks. And now just to put it into context, so more recent comments from Indian refiner officials and retailers suggest that the month combined for diesel and gasoline consumption is poised to will plunge as much as 20% from a month earlier as the issues continued to move through. And then preliminary surveys on April fuel consumption from refinery officials, which will become official in May, is showing that product demand will fall by at least 350,000 barrels a day this month. So again, that's that shakeup. And now we've also seen delayed turnarounds and delays coming back on because people are either sick or just can't get the right equipment to do those turnarounds. So that's going to become a bigger issue. And this just puts it into context in terms of where that stringency index is. It's at about 70% as those cases continue to move higher. We are seeing some vaccines administered increase, but now there's this pushback on should the U.S. sell 60 million extra doses of AstraZeneca or give them to India. And this is some of that friction, as we can see that congestion index moving from 41.5 April 18th to just 17 on April 25th. And that's only going to get worse as people try to lock down and do less. But when you were also starting to see some adjustments where high sulfur fuel oil conversion economics have actually become more attractive than heavy crudes from Basra. So again, these are some of those friction points when we look at, what are people trying to do? How are they trying to make money on the refining side, given some of those margins? And then this just puts it into context when we look at India and some of these relapses. When you look at the mobility, the national mobility, and then the largest, state, just when we're looking at how weak a lot of these areas have come and what that does to PMI when we turn to industrial movements and that demand level. So these are things that are going to continue to hit the global market, and that's obviously going to become a bigger issue when we look at how is that going to impact U.S. exports and U.S. imports. And when we look at, as we said earlier with the crude, we flatlined, and there's not much to see going one way or the other. We should see an increase in exports over this week into next week because we're seeing more loadings as we get to the end of the month versus the beginning of the month. So we should see some of that acceleration. Now, when we look at Pad 3, we're actually back to the top of the cloud. Yay, back to touching some of the gray side of the cloud in general. But again, you can see how far we remain from a normal market. And when we consider the Pad 3, which is right now only 400,000 barrels below year over year, but 22.6 million barrels above the 5-year average. So again, still a lot more to go. While Cushing sees that little increase, but as we've been saying with Cushing, based on the issues on exports, production staying fairly flat, we just see the kind of the steady movement in Cushing in general. But when we look at Cushing, we're 9.3 million barrels below the 5-year, 17.3 million below the year over year. But this is when we have peak COVID, so it's easier to look at that 5-year just to give some context. Then when we look at what has happened on the import side, imports increased 1.2 million barrels a day, which when we look at just Pad 5 was the import essentially with an increase by almost 1.1 million barrels a day. Pad 2 saw an increase of 406,000, which is what we were saying last week. And we've been saying that Pad 5 should see an increase, and we finally saw it come through. where pad 3 is going to start to see some of those adjustments, especially as they start to bring back a bit more activity. The question is going to be how quickly, because there's still a lot of crude in storage, so that they're going to try to balance that out in general. But pad 5 will continue. I mean, this is obviously a big move. We'll still see some residual. It's going to be down week over week, just given the fact that this is such a huge surge due to the delays. And then on the other side, on the import side of products, April loading shipments of clean fuels from Asia to the Americas were unchanged from a week earlier of that 490,000 tons. One went away, one came back. And just when we look at it, April's volume is poised to be the highest level since March 2020 if all of the tankers complete their voyage. And right now, based on where the economics are, where crack spreads are, I don't see these adjusting. These are going to hit pad 5, and I don't see that stopping, especially as Asian problems continue, which is why we're talking so much about Asia right now, is because that's going to keep some of this crude and some of this product funneling into specifically pad 5. Now, when we look at runs were up 40 basis points. They went to 85.4. Still right around that top end of where we think things are going to be. And it was really driven by pad 3. Now, we did have 3 FCCs have an issue. So gasoline actually went up, and that has so far started to correct itself. But that isn't picked up in this number because it happened the end of last week. So it's all a matter about when it comes back. This is what we kind of expect to be steady state through the next week or two, as we continue to see the focus remains on creating gasoline and more specifically blending components versus disti. And then the reason why is when we go to implied demand, as we were saying last week, gasoline demand was down 227,000 barrels a day. This pullback to that, we were thinking 8.8, 8.9, and we're right within that comfort zone, and we'll start to see an increase back up now. And again, just kind of trying to stay right around just below that 9 million barrel a day mark. And diesel, or I should say distillate, had that big jump, which is something that we were expecting. That will start to come down. And then jet fuel will remain steady. Jet fuel came in about had an increase of 9,000 barrels a day. That will remain. Resid is going to bounce back and forth. So really not too much coming in general as to where we see some of this bleed down from the distillate side, because we did have that residual cold movement. So again, that's going to move some of the heating oil through that really normally doesn't happen at this time of year. So that's going to be some of those benefits that will roll over, and gasoline will see a bump week over week as we go into next week. Now, U.S. imports of European gasoline remained high through April 15th, but since then they've started to slow down a bit. So when we think about where this goes in general, when we think of what the shift is, gasoline shipments have come down. Distillate is pretty much done now, but we continue to see that gasoline shipments. Now, they're down week over week, but they still remain elevated. And even though they're to a 5-week low, there's still a lot coming into our market. So then when we look at crude oil floating storage, it started to tick up a bit. Based on what we're seeing coming into our market, this should continue to trend up into the bottom of the cloud, nothing too aggressive. But when you look at just the chart in general on the 5-year average, we kind of naturally see some of these increases, and that's going to continue to be the case as we go through the remainder of the next 2 weeks. Now, when we look at imports, you had those imports coming down. This is just that timing delay. We're gonna see some of these imports come back, and as we've been saying, just staying just within the bottom of that cloud, especially as we do have gasoline being the main focus. There's going to be that balance of trying to work through crude and storage and trying to manage some of these imports to maintain that 33 to 34 API feedstock that is really the sweet spot for the refiners, specifically in pad 3. Pad 2 had the bounce in imports that we were expecting. Based on what we're seeing, we think that there's going to be another little increase instead of seeing this decline. But again, nothing too far away from that 5-year average. based on the activity that we're seeing within Pad 2 and the amount of flow through that's going to continue into our market in general. And then this is what we were saying when we look at operation utilization rates at the refining level. Things are pretty much steady state. We're not really seeing too much up or down. There's still be some residual. And then as we get into May, and when you look at that 29-year average, we typically have a pretty steady increase. We're just thinking that it's going to be a little bit slower just because we do have more imports coming through. Those will be digested. And then we'll start working our way closer to 87% utilization rate as we get into the Memorial Day holiday, which really kicks off the driving season, and when we start to see more activity on a seasonally adjusted level. So in the next segment, we'll talk about what do those seasonal adjustments mean and what does that mean for refined product demand within the U.S. over the next several weeks, especially as we get into typically a seasonal pivot higher. And what is that seasonal pivot higher? Because we think, obviously, it's going to happen. We will have more demand. It's just going to be at a reduced rate versus historics.